Hi guys, welcome back to the channel. My name is Dave, and I was gone for a few weeks. I went on vacation, and I got COVID, but I'm back now, fully recovered, better than ever. Now, it gave me some time to reflect kind of on this channel and the content that I've been putting out, and a lot of it has been about options trading. And I really look at options trading and look at it, and I put it in two categories in my own mind. And the first one is really income driven. Like, you really want to be focused. You want to become an expert at trading options. You really want to study it. You want to become an expert. But the second one is more of a way to enhance your portfolio and utilize options in some creative ways. You can kind of understand it, but you don't have to know everything about, deltas and thetas and everything else. You don't have to know all the option Greeks. You don't have to know a bunch of theory. So you can just apply it and use some simple math. And that's kind of what I think the niche is here with my channel, kind of focusing on that. So that's kind of how I want to present this material. And I recently shared a spreadsheet that I did. It's pretty basic, but it kind of goes over a lot of, how to sell a put and sell a call. And that's kind of where I would recommend people get started when it comes to options. So my long-term plan here is to kind of do a whole lab on introduction to options to really help the newbies out there kind of get acclimated to trading options in some creative ways so they can have this skill set and they can utilize it. So look for that, and if you're looking for that kind of information, please like and subscribe. Now, with all that said, today I kind of want to go over the spreadsheet and how you can utilize it. Kind of step through it step by step, selling calls and puts, and just talking about options and some, just some general ideas here. So if that is what you're looking for, please stick around. Whoop. So I do feel that for the vast majority of us, if you don't want to be hyper-focused on options, then using options as a way to enhance your portfolio is a great way to go. Because I think you can be a buy and hold long-term investor and still utilize options in some creative ways to add some spice to your portfolio. Get your money to work a little bit quicker than having just sitting there on the sidelines. So we're going to talk through some of those different ways. But I want to use a spreadsheet to kind of illustrate that you don't need to know option Greeks and understand everything about volatility, risk analysis, standard deviation, blah, 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 all that fancy math. You can do some basic math and kind of get involved if you have a little bit of patience to learn about options, that this is a great way to do it. So I'm going to be doing a whole playlist on this, but this one today is going to be kind of jumping in the spreadsheet and how to use it, because I've had a couple of people request that kind of information. So we're going to walk through selling a put, selling a call, and how this kind of all ties together. And if you like the spreadsheet, it will be linked down below. It is free to download. Again, it's just a very simple spreadsheet, but it's one that you can utilize maybe to kind of get an understanding of how selling puts, selling calls might work and function together. So if you like it, let me know. Comment down below if you do like it. If there's something that you see, that could be improved, Dave, then you can write that down there too. It will not hurt my feelings. Again, it's just a basic spreadsheet to get us all started. Okay, so first thing we need to do is set up a trade. And this is within Fidelity, where I do a lot of my trading. But you can do this with any platform that you like. So I picked Apple. Everybody knows Apple. So Apple is at 138.93 right now. And this is in the weekend, so it's just kind of a snapshot. But we'll use this information to put it over into our spreadsheet to kind of analyze and see if it makes sense for us at this point. So we're going to set up selling a put first. So sell to open. Again, you have different actions down here if these get confusing. Again, I'll go into more depth on this at a later date. But right now we're going to sell to open. We're selling somebody else a contract, right? One quantity, which is equal to 100 shares of Apple. And we're going to say you can put it to us by an expiration date. And I picked July 29th, which is out about 1 month, because this is the very first weekend in July. And you have your different strike prices here that you can select from. I'm going to pick 120, right? So if Apple falls from 138.93 down to 120, that's likely that it's going to get put to me on this date. All right, so that's kind of the setup. And for that, I'm going to get something between this bid and this ask price. So you could say limit or market. I'm just going to say market, and we're going to see what it populates here. So right now it's saying, okay, right around that bid. Again, this is on the weekend, so this isn't really accurate. If this was an actual trade, I would probably say, hey, limit at 120 or so. But that's kind of the setup. So this is Apple, $138.93. If I feel good about Apple at buying it at 120, then why not sell a contract right now? That's the whole idea with selling a put. So I can sell a put right now at $120 strike price and collect right now $112.35. That's mine. That's my premium that I collect for giving somebody the option to put this to me by this date. Now, the single most important factor when it comes to selling options like this is the underlying, in this case, what you're feeling on Apple. So I'm pro Apple, and I'll show you a trade right now too, where I've got Apple in a similar situation. So here you see that I did this back on in the middle of June, and I've collected about, let's see, I sold this for $91.31. So the exact same type of trade out about a month, and I collected $91.31. It's actually time to close this because I've collected $83 of that, which is 91%. So it only has $8. So I sold to open, right? Now I could buy to close here. It would cost me about $8. So I would net out about $83 of that 91 that I originally sold it for. So I do these types of trades. I look for opportunity when great stocks like Apple, in my opinion, drop, and I pick those up when I can. So I do this to generate some income and also pick up some shares of stocks that I really like. So we have our trade set up. Now let's port this over to our spreadsheet and take a look and see if it makes sense. So first off, we've got our date. Simple enough. And I put 7/5. It is actually July 4th, but let's put 7/5 in there. One contract, it's Apple, and there's our expiration that we picked, right? And here's our stock price. So again, I'm just entering 138.93. Simple enough, right? Sell a put, and that's the strike price that we picked as well. $120 strike price. And our premium. So again, anything in white here, these areas here, that's data entry that you need to put in there. Everything else is going to be calculated for you. And let's start this percent from strike. So instead of talking about option Greeks, all I'm doing here is I'm saying, okay, so it's at 138.93. It has to drop 13.6% down to 120 for it to get assigned to me. Okay, so does that make more sense to you? I guess in a lot of ways, I think it does. It's basically saying, would you buy Apple if it fell another 13.6% to 120? You might say yes. If that's the answer, then this might look like a solid trade for you. And in doing that and offering to do that for someone, you're going to get $112.35 right now. That's your premium that you collect when you make this trade. Important to understand that. Now, let's say 3 weeks into this trade, you decide you want to close this out. This is where you'd put that information. Let's say it would cost you $10. That would adjust your profit and all your returns down here. But as an initial opening, selling a put, it's going to be $0. It's not going to cost you anything to close it yet. So your profit is $112.35 still. Now, important to understand your put, your cost, the collateral that you need to have. So if this does get assigned, you need to buy 100 shares of Apple at the current strike price that you agreed to, or 120. So 120 times 100, that gives you that $12,000. So Apple's kind of expensive, right? It's over $100 a share, so you need to have that $12,000 available to buy those shares if it's going to be cash secured. So this date minus this date, that means you're going to hold this for 24 days till expiration. Got it? And this is your return on that cost, okay? So the cost that you've got here, and again, if you double click, you'll see where these numbers calculate from. But again, it's getting you about 1% over those 24 days. And if you annualize that over 365 days, you would get a 14.24% annualized return on your $12,000 of collateral. So that's where all those numbers come from. Now down here at the bottom, I gave you 3 different ways to kind of think through this trade, see if it makes sense. Right? And the first one here is stock above strike. So the option just simply expires. So if it comes down to this 7/29 date, you haven't done anything, you haven't closed it out, and Apple's at $130 still, well, then that option's going to expire. And when it does that, you're going to keep your $112 that you collected when you made this contract in the first place, which means you're going to get about that 1% return, or about 14% annualized return on your $12,000. So you're off to a good start, right? If you do this all year long, you would make 14.24% on your money. Feel pretty good. And you would never have owned a stock. Now, stock price at expiration. This second one here is basically saying, okay, let's pick a number. And in this case, I said, what if it drops all the way to 110? What's the damage here? Well, you would have lost $1,000 on the stock itself because you agreed to buy it at 120. It dropped to 110. So it's at 110 right now, and you had to buy it at 120, so you lost $1,000 there. But you did make $112 in premium when you sold the contract. So altogether, you're out about $900. And if you annualize that, obviously it looks horrible. So let's not forget, though, that you do own Apple stock at 120. So this is just kind of a quick way to look at it. Again, this is something that you can change. So if you wanted to say, okay, well, what if it drops to, I don't know, 119, just below my strike price? Well, in that case, you would have lost $100 on the stock itself at the moment, but you would have still gained 112 on the premium. So you still have a tiny little return here. So this is kind of your, risk gauge. How do you feel if it drops to 80? How do you feel if it drops to 150? Well, obviously, then you get the full return. So you can play with that. See how you feel about the trade. Now, break-evens are really important when it comes to options. If you're not familiar with them, this is the point where you're exactly at zero. So your break-even point for this is 118.88, because that's the number where you take 120 minus the premium that you collect gives you 118.88. So in this case, you can afford to lose $112.35 on the stock because you made $112.35 when you sold the contract. It gives you a 0% annualized return. So that's the breakdown, and that's how this spreadsheet works. Again, if you have any questions on any of this, please just ask down below. We'll kind of go over it. If there's other information you think would be beneficial, we can throw that on here as well. Now, the opposite side of this trade is a covered call calculator. So we're going to jump in there and talk about this again with Apple. And first, let's set up the trade. So now let's go back to our original trade here where we were selling to open one put contract. Let's say we now own the shares. So let's say you have 100 shares of Apple. Maybe they were assigned to you because you sold a put, and now you want to sell them because you think it's overvalued, whatever your reasoning might be. Or maybe you've had Apple for years and years and years, and you bought it at 80. It's at $138.93 now, and you've decided you want to go sell a call against that because you think it's overvalued and you don't like it in this stock in this current market. So you're willing to get rid of it. So let's set up a trade here. Apple 138.93, and now we're going to give some of the option to call away our shares at a certain strike price. So again, same thing. We're selling to open one contract, but instead of a put, we're saying you can call our shares away. We're going to use the same exact expiration, and we're going to use a strike price of, I think 150 is a good, nice round number. We're going to say at $150 a share, you can call it away from us. And here again on the weekend, you're going to get somewhere between $1.51 and $1.70. So at a market order, we're going to say we're going to get around 162.35. That's kind of right around that midpoint. So we've gone from selling a put to selling a call. And again, now we're giving the option to someone else because as the seller, they have the option, right? We sold them the contract to call away our shares by July 29th at $150 strike price. So if it goes up above 150, it's going to get called away. If it stays below 150, we're going to keep our shares. But either way, we're going to keep our premium. So again, we're putting our shares on the line here to get called away, but we're actually able to generate some extra income. So this might work out. Let's take it over to our spreadsheet and just take a look and see if it makes sense to us. So let's take a look, and this time we're using the covered call calculator. Again, we call it covered because you own the 100 shares. If you didn't own the shares, it would be a naked call. I don't recommend that. If you're brand new to options, you really want to understand how everything works first. So you want to own the shares and offer to sell them to someone. Much cleaner way to do it, much better way to handle it initially. So again, date, number of contracts, it's Apple, same expiration, same stock price. We're selling a call now though. And we picked a $150 strike price, which means that if the stock rises another about 8%, it will get called away from us. And now, are we happy with that trade? That's what the rest of this analysis is really about. Because for offering this contract, we got a premium of $162.35. That's what we plug in there. If, let's say, 3 weeks into this trade, we decide we want to close it, how much would it cost us to close? $10, whatever it might be, and that will adjust everything. Now, it gets a little wonky here because this is the call cost, but we need some reference point here to kind of calculate what an annual return might look like. So let's say, for example, the stock price never changes. It just stays at $138.93 for the next 12 months. And you continue to sell this call each month. Well, that's kind of going to give us a annualized return that you see down here. So this is the return on this cost, okay? And if you multiply that out to 365 days, basically if you repeated this every month, you would make about 17.77% on your money. You would keep your shares, nothing would change. So that's kind of the information that you're getting from that right there. Now this next section in here is I added in for dividend. So let's say you have a dividend paying stock and it pays out 20-cent dividend per share. The next one maybe is 717 and it pays out quarterly, which means you pay 1. Of course, you're entering all this information, but it'll add that dividend that you might collect into there as well. In this case, Apple does pay a dividend, but it's not payable during this time frame, so we're going to leave that as 0. The bottom portion down here is all about analyzing our trade again. So let's say the stock price is above the strike and it gets called away. So in that case, anything above 150 and it's going to get called away, which means you would have made $1,107 from this price up to 150, plus you get your premium. So that's the total amount you collected. So you made 9.14% on your money that you had invested in this stock from that point in time. All right. If you analyze it, it'd be 140%. Now, you can't really do this on an annualized basis. You're looking at an individual trade, but I can still leave that in there. So if you could repeat this every month or every 24 days, that's what your annualized return would be. Now, the next one here is a little bit more interesting. This is the stock price at expiration. So if you do have a stock here, and let's remember it's at 150 is where it gets called away. In that case, you'd make 1,107 at 162, and it would look just like it was above. But at, let's say, 145, well, you still made $607 because the stock went up in value from where it was previously. So it's kind of a snapshot, right? We got our premium that we collected, so we have our total amount, which gives us a 5.54% return from that snapshot point that we took up here. And that would give you an annualized return. Again, you can't really say, hey, this is going to happen every month. This is how it's going to work. But it's just kind of a way to look into it and say, okay, well, where is it at? Now, in a declining market like we've been right now, for all we know, the stock might drop all the way to 125. In that case, it's going to show you a negative return, because you're going to lose $1,393. But the nice thing here is if you hadn't done anything, if you hadn't taken action, then you wouldn't have collected that $162.35. So this is really what we're after here. We're after that premium. We're there to protect ourselves. So by selling this call, we're collecting that extra premium. And then, of course, down here at the bottom again, that same break even, that really important number, that 137.31. So again, stock's at 138.93. If you take no action and it goes down, you lose the value of that stock. Clear and obvious, but you still keep your stock. In this case, we put $162 extra in our pocket because we sold this, so our break even within our stock goes down, and that's what this is all about. So we lost $162.35, but we actually made that back in premium, so that reduces our break even now from 138.93 down to 137.31 if this was our break even initially. So that's how all of that works. But again, any questions on this at all, please ask down below and we can pick it apart. Let's improve it. And if you're new to options and you're not used to looking at an option chain, I would recommend it. You start pulling this information up. As these types of trades make more sense, the option chain will as well. So this is the option chain for Apple currently for that July 29th expiration. And we can look at that $120 put that we talked about, and we can see our bid and our ask that's up there. We can kind of follow that up along here and start looking at our deltas and our gammas and theta decay and everything else that's in there. And on the other side, we have our calls. We can go down here to our $150 strike that we selected and see if that makes sense as well, looking at our deltas. So you will start seeing how these two can tie together. It's a nice thing to start making sure you're kind of aware. But I think, you know, between using these types of calculators and using an option chain, it will start to make more and more sense as you use it. So there you have it, just a very simple spreadsheet that you can utilize to kind of break down some of these trades when you're first getting started with options without introducing option Greeks and a bunch of this other technical knowledge that you're going to develop over time, but you don't necessarily have to have it right up front to kind of get, you know, interested in trading options. Now, I do lots of trades based on this type of math. I go into lots of trades, and there's plenty of videos I'll link down below that you can kind of see. If you like this kind of presentation, you can go back and watch some of those, and you can kind of see how I approach some of these trades. So if you like that kind of information, like and subscribe and watch those videos. Now, if you have any questions on this at all, please ask down below. I'm happy to get back to you and answer any questions that you might have about trading on options or anything else wealth related. That's what we talk about on this channel. If you have any great ideas, let me know. I'll utilize them. So we'll see you next time. Have a great night. Take care. See ya. Bye.